Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is Anthony Grisanti, who's a CNBC contributor and one of the panelists on Futures Now. Anthony, welcome to the show. Pleasure having you.
Thank you very much for having me.
Now, it's also interesting to have you here because you actually conduct your business on the NYMEX. You're coming from that old line of floor traders, the dinosaurs. I'd like to start off just by, just if you could tell us a little bit about that. It's now an anachronism with all the electronic trading, but you're literally still down there on the NYMEX. What goes on down there?
Well, Mike, we still get to see the screens where things are trading. There is a little bit of paper that still comes into the rings, especially in the options market. But, basically I treat it as an office and a place to gather information. So I still talk to my old clients because I really don't keep many anymore. And I'm still able to do my business from down there because I have a computer and everything else. But all the trading is mostly done on the computer.
Yeah, I tell you, I miss it. Like, we remember it back in the heyday. I was back there in the 80s and the 90s. It was the open outcry system, which some people would argue is actually more efficient than electronic trading. Would you agree with that statement?
I would agree up to the point I think it's actually more transparent. When I looked in the ring and I looked at certain brokers, I knew who they were doing business for, what the business was for, and everything else. Now I look at a computer screen, I don't know who's on that screen. And then you have all the black boxes that have taken pretty much over a lot of this trading. So you don't know what's real, who wants to actually buy or sell this market, or it's a black box trying to pick off inequities in the market.
Yeah, well, it's definitely here to stay, so I think we all have to adjust to it. Now, you are active in the commodities markets on a daily basis. Obviously, you host the show Futures Now on CNBC. Why don't you give us your overview now of the commodities space? I mean, how's it looking? Obviously, we're facing potentially the fiscal cliff, a global economic slowdown, although growth here in the U.S. seems to be picking up. How does it pan out?
Yeah, I mean, the show itself is focused on commodities, and I've been trading them for 25 years. You know that. I think overall, when you look at the space, there's certainly a lot more interest in commodities than there was 5 or 6 years ago. But right now, you've seen a lot of things run over the last 2 years, 3 years, really since Obama started the QE, the stimulus. You've seen gold run, you've seen silver run, you've seen mostly metals, the oils run. You had the problems last year with the drought, and that caused the grains to run.
Right.
So everything is really near historical highs right now. And I think when you talk about commodities and the fiscal cliff, if we go over this cliff, I'm looking for a massive sell-off right across the board.
Would that be a buying opportunity?
I think in certain commodities it definitely is, and others maybe not at the time. The ones I look at right away that would probably be buys are the metals, only because no matter what happens with the fiscal cliff, stimulus continues, and that weakening of the dollar continues, and that makes commodities more expensive. So I look at that going, crude oil maybe not right away, but certainly that would become a buy. And the grains, if you look on the 10-year supply of grains and the demand for grains and what's going around the world, you have to be a buyer of any dip there too.
But on this dollar point, and I've brought this up in the past. I mean, if you look at the dollar index, which a lot of the dollar bears use that as a proxy for the dollar, right? If you look at the dollar index in 2008, right before the Fed started to engage in all these extraordinary measures and the Lehman bankruptcy, and all that has been done since then in terms of the expansion of the balance sheet, $3 trillion in reserves, the so-called printing money. And if you look at and not only here but everywhere around the world, if you look at the dollar index, it's actually higher now than it was back then. So I'm a little confused when you say the dollar goes down because of all this stuff, because it really hasn't. Well, it went down against some things, it went up against other things.
Absolutely. But here's what I'm looking at when I look at a dollar. I'm looking at basis the other currencies in the world. And I look at all the problems that China's having, that Europe has been having, that, basically around the world. And I think those currencies have weakened a bit too. So that's made our dollar relatively strong compared to those. And when you look at the dollar index, that's kind of what you're seeing. But I think if everything was a level playing field, straight across the board, and we continue stimulus, I think you're going to see the weakness in the dollar. Because I remember when crude oil was trading, say, $50 or $60 a barrel. that dollar index was in the 82, 83 handle. Now it's in the 79 handle.
Mm-hmm.
So I'm looking, and it probably would be a lot lower than the 79 handle if the rest of the world currencies weren't doing so bad.
Now, you're a veteran futures trader. You've been doing that for 20, 25 years. But most people really didn't have any exposure to futures. It wasn't the sort of a thing that a retail investor, certainly somebody who was familiar with investing in the stock market, would do. How much influence do you think the advent of these new instruments like commodity ETFs and this sort of stuff, how much has that changed the game?
Well, I think you hit the nail right on the head. It's the ETFs. I mean, they have ETFs for everything, from gold to silver to oil to grains. And I think what that does is it makes it clear to most investors, the smaller investor, that, hey, this is traded like a stock. But, fundamentally, there are issues with ETFs that I don't like trading when they roll and you lose money on that, things like that. So I like to say pure futures play, and that's the way I've traded it. But it certainly has added a lot to our markets. In fact, a lot of people are talking, well, gold, the reason why it's rallied is because that ETF, that big one, the GLD, you get long that, and you can't really short that ETF, or nobody shorts it. So it's run because of all the money that's pouring into that. And I don't see it ending, so...
But as a side story to that you're seeing a lot more of less sophisticated investment coming in.
I would completely agree with that. I mean, as well as I do. When we traded commodities, say, in the early to late 80s, this was users, producers, and a few hedge funds, things like that. You don't have the exposure it is right now. And I don't think that people realize the amount of money that can change hands, how they can lose money, and if they just treat it like a stock, that's the wrong way to go about it.
And it's kind of hard to define even a speculator now, because as you mentioned, in our day, we played both sides of the market. So there was some balance there. But now speculators are almost these large institutions, pension funds, for example, endowments, who take long-only positions through these vehicles. And that's maybe the dynamic that's causing these markets to change. Whereas in the past, I guess you could argue they were cyclical in nature. Now it's more of a secular rise, don't you think?
I would completely agree with that. I think that, most of the hedge funds are long only. They don't go short. And I think they just put in their money. They roll it every month, and that's it. And owning gold now is like owning stocks. I mean, you want that as part of your portfolio. So I think that's the reason why you're seeing this.
Now, you rely a lot on technical analysis when you trade. You're more of a short-term orientation, I think. So what are the parameters that you use?
Yeah, I wouldn't call it day trading so much, but definitely I'm looking at the technicals. I keep the charts. I look for the big moving averages, the 50, the 100-day, the 200-day moving averages, things like that. And then I sprinkle in a little fundamental analysis along with it. Certainly if I see oil, which has, the last few sessions traded down to $85, it's bounced every single time. And I think that's a reflection of what's going on in the Middle East, geopolitical-wise. I certainly wouldn't sell it. Absolutely.
So when it gets down to 85, you're looking to be a buyer.
It's been a buyer on the charts every time. Now, the way I look at it now we're between $85 and $90, and it's failed at $90 a number of times. The way I'm approaching this market right now is geopolitical's on the back burner. I'm kind of looking to sell these rallies now. I think the next time down, it gets through that 84.5, because I don't see the geopolitical holding the market up like it did. And oil is a very well-supplied market right now.
Are you talking mostly about the Iran situation, the potential for conflict there?
Everything that's going on, Gaza, Israel, Iran, what's going on with Syria, everything else. I mean, Syria is obviously not a producer of oil, or not a big producer. Gaza, no, not at all. But you have to keep your eye on these things to see if they spread out from those regions. But now I shift more to the fundamentals of the market. Oil's very well supplied. World economies aren't doing great. Geopolitical's on the back burner. I'm looking to sell rallies in crude.
So summing it up, a break below 85 would be bearish.
Absolutely.
If we go over the fiscal cliff, it's basically bearish for all of them, but you'd be a buyer of metals if that were to happen.
I absolutely would, and look at the grains also, because I think with that, you have to look at the fundamentals. We have very tight supplies. We had the drought last year. What's going on in South America and in Europe, the Ukraine especially, has not been good for the growing season. And if we get one more bad summer here, this is really going to put a lot of pressure on supplies and pressure prices upwards.
All right, Anthony Grisanti, CNBC contributor for Futures Now.
Thank you.
You're welcome. That's it for now, folks. This is Mike Norman saying bye-bye. We'll see you next time.